growing over the stability of what was a tech-focused lender in the Valley. Many called it the backbone of Silicon Valley. It lost nearly $2 billion selling assets following a greater than expected decline in deposits. But here's the problem. Venture capitalists reportedly advising their portfolio companies to pull their money from the bank. Those concerns, of course, rippling through the banking sector. The KBW Bank Index posted its biggest drop since the pandemic. Regional banks, Comerica, KeyCorp, and U.S. Bancorp hit hard as well. You're looking at those stocks this morning. We're going to discuss this right now because of the potential for contagion risk. Hugh, CNBC.com banking reporter. Good morning to you. To me, it's not even clear to me that Silicon Valley Bank unto itself would be a problem insofar as when you have people like Peter Thiel telling their founders, you gotta get your money out, that unto itself can create a run.
Yeah. So, Andrew, I've spent the yesterday afternoon into the evening talking to founders, talking to VCs, and the consensus is people are saying we don't know if Silicon Valley Bank is really under duress or going to have issues, but we don't want to wait around to find out. If you're going to panic, it's best to panic early. You don't want to be last in line to trying to get your money out. And so there have been, all portfolio company emails sent from the likes of founders funds and other prominent VCs who are saying, if you've got more than 250K, it's best to move it around. And I spoke to one founder who did so and said, it took about 5 clicks. It wasn't very hard to do on their online banking platform. And was able to get their money out. Now, there are other anecdotes of people who have had issues with wire transfers not going in quickly and not going in smoothly. And so there could be some breaks in the system. Also, some anecdotes of people having trouble logging on in the afternoon. So that could indicate there's a lot of traffic on the Silicon Valley website.
How concerned should people be, not just, though, about Silicon Valley Bank itself, but whether we think there's a contagion, whether we think this is going to spread?
So the takeaway I've had from the people I talked to is this is like 2008, but only for crypto and startups. And so the hope is that it stays there. I think the concern in terms of knock-on effect is, I talked to a founder last night who said, I don't have any money at SVP. I was told to pull it out if I did, but I don't have any exposure there. However, I'm trying to extend a debt refinancing. And Silicon Valley Bank and others were specialists in this, and they're not doing it anymore. And it's risk off. And so I'm not going to be able to make payroll potentially in the next coming weeks if I can't do this refinancing. Term sheets for startups are going to get pulled in this person's estimation. So the knock-on effect is you could have, and we've speculated for a while, that there needs to be an event in which all of these unprofitable startups that exist that were created in the zero money, interest era, need to actually, there needs to be a reckoning there. And it's possible that this is a thing that incites that. It is not clear. I want to be, careful to say that. But in terms of knock-on effects, I would look there first.
Hey, Hugh, I think this is a bigger issue. You start looking through what happens, and Jim Cramer talked about this yesterday when we spoke with him on our air. He said there are cracks everywhere. This is what happens when you have the Fed raising rates. You have liquidity getting drawn in, and it's probably not surprising that one of the places that this would be an issue would either be a crypto bank or a bank that specializes in tech startups that are having problems getting money elsewhere, so they need their money back. But I do think there's a bigger problem that this is highlighting. And if you look at any of the big banks yesterday that were down 7.8%. You're looking week-to-date numbers here. Citigroup down 8% for the week-to-date. Bank of America down 11%. Wells Fargo down by 13%. J.P. Morgan was down significantly. Schwab was down 11 or 12% yesterday. And it's because a lot of these banks hold something, it's an accounting rule that says these banks can hold bonds and not mark them mark to market. They can mark them hold to maturity, which is fine. If you plan on holding some of these bonds that you've been holding all along to maturity, you can do that. And those are your best plans, that you're holding all these bonds to maturity. But if you have customers who want their money back, you can't hold them to maturity. You have to sell them, and in some cases at a very big loss, because bond prices have been collapsing this year as the Fed has raised interest rates. I think that's when you look at some of the bigger banks, what the concern is. People are just digging through. And this may be a case of sell now, ask questions later. But people are digging through, looking for these hold to maturity sort of situations where the accounting numbers are valuing the bonds at a much higher level than they'd be worth if you were forced to sell them today.